Hi, this is Kevin Kerr for Money and Markets TV. In about 6 weeks, when we ring in the new year, many traders, fund managers, and individual investors will be happy to say goodbye to 2011. This year has been one of the most volatile I can remember, presenting a major challenge to even seasoned traders. In the commodity markets, everything from gold and oil to base metals and coffee has been on a roller coaster ride that doesn't seem to end. And grains are no exception. The price of corn, wheat, and soybeans have fluctuated wildly over the past year. During the second half of 2011, the weak global economy, combined with better than average crop yields, dragged down prices. But as we look forward to 2012, I believe the market is going to turn around dramatically due to rising demand. Emerging markets continue to buy more and more grains, especially soybeans. And banking giant UBS agrees with me. Grains are one of the asset classes in which it recommended an overweight rating. In addition to rising demand, farmers are facing more and more pressure in the form of higher input prices. According to the latest Ag Economics report from Purdue University, growing corn, wheat, or soybeans next year will likely cost much more than it did in 2011. Inputs like fuel, fertilizer, and seed costs are rising exponentially. But the one cost that's going up faster than any of these is rent. The price that some farmers have to pay for their land could increase by another 12% next year. Overall, these higher costs are going to put an incredible burden on farmers. That burden is going to be reflected in the futures markets and in the prices that we pay at the grocery store. The most obvious way to turn a profit from this trend is to play the commodities markets directly, buying futures or options on corn, soybeans, or wheat. Or you could invest in an exchange-traded fund, such as the PowerShares DB Agriculture, ticker symbol DBA. But you also might want to consider buying shares in some of the key companies at the bottom of the food chain, so to speak. I'm talking about fertilizer and seed suppliers, such as Monsanto, Agrium, Potash, and Syngenta, among others. Farm equipment makers, such as Deere & Company, may also be a smart play. These are all companies that are sure to benefit as agriculture prices rise. The bottom line is that even in down markets, agricultural commodities often stay very strong. After all, everyone has to eat. If you're able to pick a few good stocks in this sector, you'll be sure to grow your wealth in 2012. I'm Kevin Kerr for Money and Markets TV. Thanks for watching.